Welcome back, traders and investors. We have Greg Harmon on the line. He is CIO and partner at Presidium Capital and founder of Dragonfly. Greg, how you doing this morning?
I'm doing good, Joel. How are you?
Doing good. Just before we get into the interview here and our subjects we had lined up, Yayo is talking about some of the influences in gold prices and is it a waste of time to look at the technicals? And gold has a kind of like a peculiar spot in the market, for the fear trade and whatnot. I seem to follow the technicals a little bit. Is that a market you dabble in at all?
I don't trade gold, but I look at gold as an indicator of what might happen in the broad market and how it might influence like the S&P 500. And to me, 1,300 has been a very sticky level for gold. It can't seem to get very far away from it since it started pulling back on the 1,500 level. So it's been there long enough now that I think that I've reverted from it being in a downtrend to being more in the neutral zone. But it's just not interesting to me.
Yeah. I mean, one thing I noticed looking at the gold, I follow it kind of the same way Greg does as an indicator. Is after the big moves, consolidation. That's really the key. After it has those big moves and see a continuation, and then the breakout or breakdown from the consolidation. So something to keep an eye on. Greg, we got an interesting topic here to talk about, and Dennis and I mentioned it a lot too with some of the institutional order flow. But you're talking about like the round number effect, and the S&P getting near 2,000, the spider getting near 200, the triple Qs at 100. Do you think those kind of act as magnets for the market? Like it's only a matter of time before the spoos get to 2,000 here, since we've gotten so close?
Well, I don't know if I'd say a magnet, but as things are approaching it, psychology shifts with traders and investors. All of a sudden, they start to think of this as being like some kind of a threshold that's an important level where it's really just another number. And it's funny because we started talking about gold and 1,300 being an important number there. People just seem to like round numbers. You said it, 100 in the Qs, 200 in the SPY, 2,000 in the S&P 500. We're right at 4,000 in the NASDAQ. We're hovering around 17,000 in the Dow. It's just been a level, these round numbers that get people thinking.
Do you think that?
It's like buying a car. If you see $20,000, it has a different impression on you than if it's 19,950.
Okay, yeah, right. Or 99 cents versus a buck. That's a good point. Do you think that this has kind of been exacerbated by the sub pennies and the pennies and things like that? That people instead of having 8 or 16 increments to trade in and all the pennies, now they're just like, hey, just put me out at the half, or put me out at the even number, or put me out at the lower even. Do you think that's had an influence on this, or do you think there's something that's been around for quite some time?
I think it's been around for a long time. If you look at 200 on the SPY, trading 199.99 as opposed to being able to trade at 199.50, it's not a huge difference, right?
Correct.
So these numbers have been important. Round numbers have been important for a long time.
Okay. Now a lot of people like to follow the small caps, and they kind of look at the small caps as kind of an indicator for the overall market. Now, if you're using that thesis here, the small caps have topped out and are quite a distance from their all-time highs, as the S&Ps are really still within 8650. So we're still within 10 handles of that all-time high. You looking for a little bit of a sector shift here? Maybe people peeling out a little bit of the small caps and or out of the big caps into the small caps and nudge the small caps back up there? Or do you think the IWM here gave us a real good sell signal for all the markets?
I'm of the opinion that the IWM is consolidating the moves that it had. It had been leading on the way up, and if you look at a weekly or a monthly chart, it's been in a sideways consolidation range. Granted, it's been a wide range between like 109 and 120, or 1100 and 1200 on the Russell 2000. I wrote a piece about this a couple weeks ago on my site about how there are 2 or 3 embedded inverse head and shoulders that have price targets right in this range between 1100 and 1200 on the Russell. So it's not surprising to me that there's some consolidation here. And for the participant that's looking for rotations that help the market continue to be strong, it makes sense for the Russell to take a break while the S&P, the Dow catch up, and the NASDAQ catch up. And it's really what's been going on, in my opinion.
Okay. All right. Is there any key levels here that you're looking at in the Russell that would help change your thesis?
Yeah, below 1100 in the Russell or below 109 in the IWM would make me think that maybe there's a bit of a pullback in the future coming. Or if we get new highs, then perhaps as you had suggested, maybe the rotation is played out and it's ready to start to get back into the small caps again.
Okay, let's talk about your book a little bit. Trading options using technical analysis to design winning trades. Tell us about your book.
Well, it's a book about my process. I'm one that believes that you need to have a process and follow the process day in, day out for forever to be prepared to trade the market. I wrote it in 4 parts so that a beginner could take the book and start to get some value out of it. The first part talks about how to identify the trends in the major markets. The second part then gives an overview of technical analysis from various perspectives. The classical perspective using Fibonacci's and other quantitative methods, using indicators, using patterns to create a mosaic to find stocks that look like they may trade with the trend. And then it gets into the options in the third part, but in a way that makes it very little math intensive. Options don't have to be scary. Options can be about just about controlling risk and limiting capital at risk. And then the last part of the book is just a smattering of various thoughts I had about how to determine position sizing and other aspects, how do you actually execute the trades to make it more practical and tie it all together.
Are you what are your time frames for your trades? I mean, the weekly options, they give you a huge bang for the buck. Are you like to go a little bit more longer term than that? Do you play the weeklies, and if so, are you doing that because you're looking at at a potential catalyst, earnings, or something like that in an issue?
Yeah, for the most part, I'm looking at the near month or the next month out. So I'm trading stocks based on daily charts that looking for swing to position trades. But occasionally I do find longer trades. I did like a bullish risk reversal on AmerisourceBergen, ticker ABC, a few weeks back that paid off well yesterday using November options. And like you said, I do occasionally take trades in the very short term for earnings catalysts. We traded Deckers last night using a weekly, or in this case, actually 1 day left, call spread risk reversal to trade the upside potential in that stock.
Could you walk us through one of the risk reversals that you just mentioned?
Yeah, why don't we talk about the Deckers since it happened last night?
Okay, go
looking
ahead.
at the technical setup on it, it really looked as though it was set up to explode to the upside if it got the positive response to earnings. And with the pattern that it was in a what we call an ascending triangle. It looked like it could take a long time to go for a long duration, and you could take August options and play something like the current level at the time, about 87.5 to 95 on a call spread, and then look at support levels down around 80, around where the moving averages were to sell a put to help finance the trade. So the structure of the trades The risk reversal is to buy, the bullish risk reversal is to buy upside calls and to sell downside puts to finance the calls. So it's also known as being like synthetically long the stock. The trade that we actually put on was the July 88.90 call spread. And that was based on what it might happen to the stock in a shorter move with the with what the options were signaling in terms of what was priced in the at the money straddle. And then selling that same July 80 put. So I'm long the July 88.90 call spread and short a July 80 put. I was able to put that trade on and get paid a 45-cent credit for it. And it looks like today I'll be able to let it cash out at $2. So not a bad trade.
And what was your maximum risk on that?
Well, I've got essentially $80 of downside risk at the maximum if it went to zero because I'm exposed to buying the stock at 80 if the stock closed under 80 today.
Okay, so they're pretty risky trade then.
Yeah, it's not for everybody.
Okay. And so are you usually doing, more spreads, more complicated things? Are you ever just outright purchasing puts and calls, or do you usually, do a butterfly or risk reversal or something along those
Yeah.
lines? So you're selling a leg, at least if you're not necessarily right, not necessarily wrong, you're taking in some premium onto the decay.
Yeah, and we've got clients that have a very healthy risk appetite as well as clients that we're trading IRAs for them, and they can't do these types of things. So that we do some complicated spreads, but we also do some things that very much so limit the risk, but also help the financing. Things like call calendars for the upside or call diagonals, where we'll buy a longer dated call and sell a shorter dated call to reduce the cost.
Okay. Cold Slug is popping in here, and he's asking about Walmart and ISSI. How'd they work out this week?
Well, he may have seen that I got stopped out at ISSI, which has not been great. But, if you're stopped out, if you've got your risk adjusted at the start of the trade and you get stopped out, it's still a winner. You didn't let it run, right?
Right.
Walmart was one also that I wrote up as a potential breakout. That never did break out. In fact, I think it was 2 days ago I wrote about the potential for that if it broke above its bull flag. And the next morning, before you could do anything about it, the CEOs turned over.
And just to go with your whole number theory that you were discussing earlier, I mean, going back to July 15th, look at all those highs right around the $77 level. And then yesterday couldn't opened lower and kept on moving in that direction. So there's a good example of like the whole number, the seller, holding on, sellers staying at a consistent level around a whole number and then it giving out. Another great example of the whole number theory that Greg's been talking about here was GM at $38 level. Banging its head. Do you have do you just go and look at that stuff by eye, or do you have filters that pick that stuff up for you?
I look at it by eye, actually. I've got a universe of about, I guess, just short of 1,100 stocks.
Wow.
I take a look at least once a week, and the ones that are interesting, I keep looking at during the week.
Okay, final question here. Jared owns a little bit of Deckers in his portfolio, getting a nice pop here off earnings, taking a look at the stock. I mean, sometimes these things open up and keep on running. Any kind of technical outlook for Deckers?
Yeah, the move that I saw yesterday as a potential, as I said, there's a longer ascending triangle that goes back to the March timeframe, and that ascending triangle has a target of 106.50. So technically, it's set up to continue much higher.
Okay, we'll keep an eye on that. Greg Harmon, CIO and partner at Presidium Capital, founder of Dragonfly. Also, you can take a look at his book, Trading Options Using Technical Analysis to Design Winning Trades. Greg, thanks for coming on today. Have a good trading day, a good weekend, and we'll speak to you again soon.
Thanks for having me, Joel.
Okay.